Good afternoon, everybody. Good afternoon, friends. Great to see you here. Today, it's my pleasure to introduce some of the major changes in the 2025 IFRS for SMEs. And there are 105 changes in this new standard. The detailed changes are in the appendix to my presentation today. So if you look at the appendix to today's presentation, you will see that there are 105 changes. But most of the changes are editorial, small changes, or they are specific to particular industries. And I will exclude them today. Today I will be reviewing only 20 changes. The IFRS for SMEs, the 2025 IFRS for SMEs is not required to be implemented. It's not mandatory until 1 January 2027 for periods beginning on and after 1 January 2027. But I think today you're going to see that there are some changes that are really helpful. So many of you may wish to adopt early or implement early this standard. Today, I'm going to be reviewing the 20 changes. And in selecting the 20 major changes, I did use my judgment. I identified changes that are relevant to single company entities in Cambodia. And I have omitted from my presentation the changes affecting groups, business combinations, investment in associates, joint arrangements. I've also left out certain topics that are more relevant for larger business, such as share-based payment, pension obligations, and hedge accounting. I've left those out too. Another missing part of my presentation, or missing part today, is the transition. The transition is going to be a separate workshop. We will have a separate CPD in September. And that presentation on transition will be presented by a member of the IFRS for SMEs working group. Before I continue, let me do a quick check. Today's presentation is going to end at 4:30. We'll have a short break in the middle. So around 3:25, we'll have a short 10-minute break. IFRS for SMEs is an international standard issued by the IFRS Foundation. But it is a relatively new standard. The very first IFRS for SMEs was issued in July 2009. And the second version was issued in May 2015. And the standard is revised or amended only every 5 or more years. And we see from May 2015 all the way to February 2025, there were no changes. So 2015 was the second edition, and then February 2025, we have the third edition. So there were no major changes for about 10 years. And that's purposeful because the IFRS Foundation, they want to give a stable platform for companies to follow. Nevertheless, there was a small amendment in May 2023. They introduced an amendment before issuing the third edition of the standard, and that amendment was an amendment for Pillar 2 taxation, which is relevant to countries that have adopted Pillar 2. In Cambodia, we have not adopted Pillar 2, so it's not relevant to us. The third edition that we are studying today, we're looking at the big changes today, was issued in February 2025, and it must be applied by January 1st, 2027. However, if you want to use it earlier, you can. You can begin using it this year. Although IFRS for SMEs is an international standard, it is mainly used in 2 countries in the world, in the Philippines and in Cambodia. So Cambodia and the Philippines are the big users of IFRS for SMEs. One change in the new standard is that the appendices now are explicitly made part of the standard. And in the appendices, there are the definitions in the glossary. So now we can use those definitions to rely on our interpretation of the standard and application of the standard. So let's begin looking at the changes. And if you have any questions along the presentation, please let me know. You can write in the webinar chat. And I will monitor that chat and try to answer your questions. So we have 20 changes we'll look at today. The first one is a change in the objective, and also a change in the way that materiality is measured. The change is that the objective of the standard now focuses on investors, lenders, and other creditors, and the information that investors, lenders, and other creditors need to make business decisions. And this is the new objective: to provide financial information that is useful to existing and potential investors, lenders, and other creditors. Now, why is this relevant to us? It's relevant because the 2015 standard and the 2009 standard said that the objective was to give information to users. It did not focus on investors, lenders, and other creditors. This should make it easier for us to identify what is relevant to put in the report, what amount of materiality to determine what is material. This also aligns with IFRS because the IFRS objective also focuses on existing and potential investors, lenders, and other creditors. So this is an improvement on the previous objective, which focused simply on users of the financial report. And again, the definition of materiality also focuses on the primary users, and the definition of primary user is investors, lenders, and other creditors, which we can see in the glossary. Another change is a change in wording, that the disclosure of accounting policy information now is material. We must disclose material accounting policy information, whereas the standard before said significant. And there was no clear definition of what is significant. So there was confusion among some companies, what is significant. So now the IFRS Foundation has made it clear that what they meant is material. And material to who? Material to investors, lenders, and other creditors. The second change that we see is alignment with the IASB conceptual framework. The conceptual framework includes the objective as well as something called the qualitative characteristics, which are the good qualities we try to include in our financial report. The conceptual framework also includes definitions of the elements of the financial report. What is an asset? What is a liability? What is income? What is expense? And the new 2025 IFRS for SMEs now aligns, it basically copies the IASB conceptual framework. So the old qualitative characteristics in the previous standard have now been replaced with the same qualitative characteristics and the same definitions of assets, liabilities, income, and expense that we have in the IASB conceptual framework. And that's helpful because the old standard had many qualitative characteristics, whereas the new standard identifies two fundamental qualitative characteristics: relevance and faithful representation. So this helps us to prioritize and focus on these two qualitative characteristics as more important than the others. And of course, relevance means being useful to the primary users of the financial report in making business decisions, decisions about providing resources. Faithful representation means being truthful, reliable, neutral. So these two characteristics are now the focus of the qualitative characteristics. There are some small changes to the definitions of assets and liabilities. The previous definition of asset relied on probability, and it said we recognize an asset when it is probable we will receive economic resources. However, now the reference to probability is removed and has been replaced with potential. So there can be cases where an asset is not probable, but due to its potential, we may recognize an asset or liability. And another big change in the definitions is the measurement basis of fair value is now replaced with current value. And the scope of current value is more broad than fair value, including fair value, including replacement value. These are the main changes in the conceptual framework. Something that has not changed is the undue cost or effort exemption. And this does not exist in the IASB conceptual framework. So this is only in IFRS for SMEs. The third change is a change that was made in order to align with IFRS to align with IAS 7. Is now IFRS for SMEs requires a disclosure of changes in liabilities arising from financial activities. And this is a requirement of IFRS, IAS 7, but it had not been required by IFRS for SMEs. Now it's required. So this is an example of an alignment between IFRS and IFRS for SMEs. And for this disclosure, we need to disclose a reconciliation between the opening and closing balances in the statement of financial position for liabilities arising from financial activities. Here is an example of such a disclosure. We disclose by the class or category of financial liabilities. In this example, interest payable, bank loan, finance lease. And we disclose the beginning balance, the changes to the balance of the liability, including cash payments, interest, non-cash finance cost, and the closing balance. This is a new disclosure that had not been required before. So everybody who is going to use IFRS for SMEs 2025, we have this new disclosure to include in our notes. Another disclosure that also is required to align with IAS 7 is disclosure of supplier finance arrangements. This is required by IAS 7 in IFRS, but previously it was not required in IFRS for SMEs. So again, this is a new disclosure that we need to include in our financial report if we use the 2025 IFRS for SMEs. We need to disclose supplier finance arrangements. And the reason for this is there had been some bankruptcies, especially in Europe, where the companies were having their trade payables paid by financial institutions. And the liability to the suppliers was being transferred and accumulated by a financial institution. And companies began to default on those liabilities, and in some cases enter bankruptcy. And previously, what had happened is companies, previous to this disclosure requirement, those companies had not disclosed the supplier finance arrangements that were paid by a third party, a financial institution. They simply included the liability and trade payables, and they did not make a separate disclosure. So now, if we have supplier finance arrangements where we have a financial institution or a factor paying our suppliers, we have a disclosure required. We need to disclose the terms and conditions, any interest rate, fees, guarantees, security. We need to disclose a reconciliation, or disclose not a reconciliation, but the balances in the statement of financial position. The range of payment due dates, how many days due, and the type and effect of non-cash changes. Here is an example of a quantitative disclosure. This does not include the narrative disclosure. So we would also need to disclose the interest rate, the terms and conditions, the arrangements. When a financial institution pays our suppliers, this is often referred to as a reverse factoring arrangement. First, we need to disclose the line item within our statement of financial position. And here we disclose, it says, presented within trade and other payables. Second, we need to disclose the amounts for which suppliers have received payment, have already received payment. Next, we need to disclose the range of payment due dates for the liabilities that are part of the financing arrangement, as well as the trade payables that are not part of the arrangement. So this is a new disclosure. However, in Cambodia, I imagine that supplier financing arrangements for trade payables is not yet common. So this might not be relevant to many companies in Cambodia. The next big change number 5, is reorganization of sections 11 and 12. Sections 11 and 12 cover financial instruments. Before, section 11 covered basic financial instruments, and section 12 covered other financial instruments. Now they are combined together into a single chapter 11. And chapter 12 now is used as a section on fair value measurement. There had been an outstanding option to use IAS 39 instead of using section 11. Now this option is removed. So now we must use section 11. We have no ability to use IAS 39. I think in Cambodia, probably very few companies were using, maybe no companies were using IAS 39. So it might not be relevant for many reporters here in Cambodia. The definition guidance for fair value that had been in section 11 and 12 is now moved to section 12, which has been renamed fair value measurement. It's worth noting something that stays the same is section 11 financial instruments continues to use the incurred loss model and does not align with IFRS 9, which uses the expected loss model. So we see that IFRS, in amending the standards, they have chosen not to align part of the standard with IFRS. They have chosen not to align with IFRS 9. And they did this to keep it easy, make it easy for smaller entities. What does it mean, incurred loss? Incurred loss means that we don't recognize impairment of a financial instrument unless there is objective evidence of the impairment. And an example would be trade receivables that are not yet late. So if you have trade receivables and none of the debtors are late in making payments, and we have no other economic or industry evidence that these receivables are impaired, then we have no evidence of impairment, so we would not recognize any impairment expense. Though we may know based on probability in the past that some of these receivables will not be collected. So IFRS for SMEs makes us wait. We wait until there is objective evidence in order to recognize impairment of a financial instrument. So that means using IFRS for SMEs, we might be slightly late in recognizing some impairment as compared with IFRS 9. IFRS 9, the expected loss model, the intention is to recognize more quickly impairment of financial instruments. Before I continue, I want to make clear what is a financial instrument, because it's kind of an advanced word. Instrument means contract, means agreement, and financial just means money. So financial instrument is agreement about money. Financial instruments includes receivables, payables, loans receivable, loans payable, shares of other companies, and also cash. So these are financial instruments. So most of you already know how to account for receivables, payables. It means you already know how to account for some financial instruments. So this is good for us that this has stayed the same. There is a new change that receivables financed for 12 months or less do not need to be discounted to the present value. And this is a big change from the previous standard, because the previous standard said that any financing arrangement, any receivable in a financing arrangement needed to be recognized at the present value. And the present value normally would be the cash price of the item. So that meant under the old standard, you could have installment payments financing for, say, selling a handphone for a period of 6 months or 8 months. And you would need to record interest and financing income. However, now the standard helps us and says that, okay, if your financing is less than 12 months, then you don't need to recognize finance income. You don't need to discount your revenue or receivable to the present value. So that makes things a lot easier for us. However, if you have financing more than 12 months, you do need to recognize a receivable equal to the present value, which is usually going to be the normal cash price if your customer did not receive financing. I have a couple examples to share with you. To share with you the reference, so it says a trade receivable shall be recognized at the transaction price. That means not the present value, unless it is a financing transaction and the entity does not apply the exemption option. So this exemption option means you don't need to discount to the present value. This exemption option means you can use the transaction price. The exemption option is in paragraph 23.38, and it's here. You don't need to discount receivables to the present value if you expect a customer to pay for the goods or services within 1 year. For many companies, the 1 year was already a kind of a rule of thumb where any receivables more than a year needed to be discounted to the present value. However, even though that was a rule of thumb for a number of companies, that was actually not the requirement of the standard. The requirement of the standard was we had to recognize the cash price or the present value for any financing arrangement. So the standard now has made it clear and helpful that it's 1 year. So anything under a year, no need to recognize the present value. So let's look at an example. So the first example here is more than 12 months. So more than 12 months, that means we do need to record financing income. So if we have a motorcycle with a cash price of $2,300, and then under installments, the price is $3,000, what's going to happen is the difference between $3,000 and $2,300, the $700, that difference must be recognized as finance income over the payment period. And let's say the payment period is 24 months. So the difference here between $3,000 and $2,300, that $700 is going to be finance income over 24 months. We will use the IRR to record the interest. Even though we have not informed the customer that there's interest, we will record some financing income, interest income, regardless of what we have told the customer. Maybe you tell the customer there's no interest. Why do we do this? Well, look at the difference between the cash price of this motorcycle, $2,300, and the installment selling price, so $3,000 versus $2,300. Why is it so different? It's so different because the seller is giving two separate benefits to the customer. First, giving the benefit of the motorcycle. Second, giving the benefit of the financing. So you're selling a motorcycle and you're giving a financing service. So in order to reflect the truth of this transaction, we are going to record revenue of $2,300 for the motorcycle, and the difference, the $700 difference, is going to be recorded as interest. We calculate the IRR. This IRR is calculated by us, comparing the receivable with the beginning receivable with the cash payments. This is a monthly IRR. So looking at the journal entries on purchase and handing over the motorcycle, we receive cash from the customer, $500. We record revenue of $3,000, which is the price that we tell the customer. And the difference is a receivable. But this $3,000 is overstating the income at this point, because this $3,000 includes financing income. Therefore, we need to reduce revenue. We're going to debit revenue, $700. And we're going to credit an allowance for the receivables to reduce the receivables. And this amount is the difference between the installment payment price, $3,000, and the cash price, $2,300. And at the end of every month, we will receive the cash payment from the customer, credit receivables, and separately, we're going to record interest income, $51. And this is based on the IRR. The IRR interest income is not recognized on a straight line basis. It is accounted for the same as a loan, where you have more interest income in the beginning of the loan and you have less interest income towards the end of the loan. And we debit the receivables financing allowance, making that allowance go down, and we credit interest income. After the payments are complete, the financing allowance will become zero. So this is the financing arrangement for more than 12 months. And it is a bit tricky, right? Because we have to record this contra account to receivables, this allowance. We need to record the interest income every month. So it requires a bit more work by the accountant. The accountant needs to calculate the IRR. Could we record the $700 on a straight line basis over 24 months? Maybe, if it is not materially different. If you have a stable set of customers, maybe there's no material difference than using the IRR. But if your business is growing, then it is likely, or your business is declining significantly or growing significantly, it's likely the difference will be material, because for new customers that are newly borrowing from you, they will be paying more interest. And for older customers, they will be paying less interest. Okay, so this is more than 12 months. What happens under the new standard? Under the new standard, they say that we don't need to record this financing if the payments are less than 12 months. Or the payments are, as the standard says, payment is received within 1 year. So let's assume that now we have a new case where payment is received within 1 year. We have a cash price for motorcycle, $2,500. We have an installment selling price, $3,000, a down payment of $1,000, and a balance of $2,000. We have payments in 12 months, 12 payments, and we assume that we're going to receive the payments within 1 year. So 2,000 balance after the down payment divided by 12, we get monthly payments of $167. In this case, we are going to recognize revenue equal to the installment selling price. We are not going to use the cash price. We're going to record the transaction as a normal credit sale. Credit revenue, the installment payment price, debit cash, the deposit, debit receivables, the difference. No allowance needed. And when the customer pays, debit cash, credit receivable. No interest, no allowance account, very simple. So this is a benefit of the new standard. The new standard makes it easier for us. Question, will the financing allowance be 0 after 24 months? Yes. So at the end of the period, at the end of the payments, once the customer has made all of the payments, the financing allowance will go down to 0. What happens when the cash price is fluctuating? Now, in this case, if it's under 12 months, it doesn't matter because under 12 months, we take the price we agree with the customer. But if we go back to that first example of more than 12 months, if this price fluctuates, you'll need to decide what is the average typical cash price for that period. And you will make the decision based on that day, on the day of the sale. So the cash price will be on that day. So hopefully you don't have your price fluctuating within the day. Change number 7 in regards to financial instruments is we must disclose an aged receivables analysis and any impairment or allowance. So this is a new requirement. We did not need to disclose this at all before. Why did they include this new disclosure? They were trying to align with IFRS 9, which requires more disclosure of financial instruments. But they wanted to keep it easy and relevant for smaller entities. And they decided that the most relevant disclosure would be an aged receivables analysis. So this is a totally new disclosure required in the new standard. And I have an example here for you. And the time bands, you decide yourself what you believe is the most useful. Time band means, should it be 0 days to 60 days or 30 days to 90 days? You decide, but I have an example for you. So here's an example disclosure. We have not due yet, less than 1 month, 1 month to 3 months, 3 months to 12 months. So these time bands really are up to you, more than 1 year. And you would use time bands. Normally, you would use the time bands that you actually use internally, that your management internally uses. Because the time bands that your manager uses probably are the same time bands that are relevant to your investors, lenders, and creditors. We disclose the amortized cost before impairment, as well as the allowance for impairment. Notice for not due yet, there's no impairment allowance. And that's because in IFRS for SMEs, we follow the incurred loss model, where we don't recognize impairment until we have objective evidence. So this is a totally new disclosure required in the new standard. A similar disclosure is we must disclose a maturity analysis for financial liabilities. So not only aging for receivables, but also a maturity analysis for financial liabilities. Now, the financial liabilities will include not only trade payables, but any financial liabilities such as overdraft, loan payable, finance lease. And to make it easy for us, we disclose the contractual maturities of the undiscounted cash flows. So the actual cash payments that will be made. And similar to the receivables analysis, we will use time bands that we consider to be the most useful. So here is an example. And this disclosure is a totally new disclosure that we didn't need to make before. So here we're disclosing the bank overdraft, trade payables, interest payable, bank loan, less than 1 month, 1 month to 3 months, 3 months to 1 year, 1 to 5 years. And the time bounds are your decision, your judgment, according to what is relevant to your business. Now, there's a question about the financing for the installment payments. If the financing states a contractual rate, can we use the contractual rate? You can use the contractual rate as long as it is not materially different from the market rate. And we should use the higher of the IRR and the market rate. So there can be cases where I'm sorry that you can't use the contractual rate. For example, let's say that you tell your customer the interest rate is 0%. Can I record financing income of 0%? So the answer is no. So you'll need to use the IRR. You will use the higher of the IRR and the market interest rate. For installment payments of goods, typically the IRR should be higher than the market interest rate. In case you calculate the IRR and the IRR is lower than the market interest rate, it is a sign to us that your estimated cash price is too high. So the next step would be to revise down, reconsider the cash price, whether it's accurate. So what that means is we will use the IRR. And the IRR should be close to the market rate or should be higher than the market rate. Another question is amortized cost before impairment means total receivables? Yes, it means the gross receivables. That's right. Now remember, if you don't have something You don't need to disclose it. We only disclose, if you don't have something, it means it's not relevant to your business. And we only disclose what is material and relevant to our business. I think so there's a question, what if we don't have a contractual agreement for a financial liability? There will always be a contract. The contract might not be written, it might be verbal, but there will be some contract. So it's best if you have a written contract, but if you don't have a written contract, then you would have to apply the substance of the verbal contract. And for looking at the market rate, now we don't want to use the market rate. It's better to use the IRR. But we do need to compare the annual IRR with the market rate. And so there's a question, how do we come up with the market rate? So the answer to that is you look at the lending rate for a bank that would give a similar loan, a bank or another lender who would give a similar loan with a similar risk. What is the interest rate that they would charge? And Lonely Kui raised a hand. I think if you have a question, the best thing is to type the question in the chat. I'll see your question. Okay, so let's continue. So I've given you here on the screen, we have the example disclosure for maturity analysis. And this is a totally new disclosure that was not required before. So all of us who use the new IFRS for SMEs 2025, we need to have this disclosure. The next big change is, I would say, is not a huge change in terms of accounting treatment, but is a change in more the organization of the standard. Is now we have a new section on fair value measurement. Before, there were descriptions of fair value in the section on investment property, the section on biological assets, the section on inventory, for example, financial instruments. Now we have one section that explains everything. The new fair value measurement aligns with IFRS 13 on fair value. And this revision, basically, it copies and aligns us with IFRS 13. So the fair value measurement practices in IFRS now is more or less the same as IFRS SMEs. And we have a slightly revised definition. Fair value measurement is to estimate the price at which an orderly transaction to sell an asset or to transfer a liability would take place between market participants. So before the definition of fair value was an arm's length transaction. Now it's clearly market, so it focuses on market prices. In IFRS for SMEs, section 12, we now have the same as in IFRS. We must maximize observable inputs. Observable inputs such as prices quoted in the market, interest rates that are observable in the market, and minimize unobservable inputs, such as unobservable input would be our own forecast, our own valuation methods, and these should be minimized when we determine fair value. And we follow the hierarchy of level 1 inputs, level 2 inputs, and level 3 inputs, which is the same as IFRS 13. And there are also now that we have a description of a level 1 inputs, level 2 inputs, and level 3 inputs, now we also need to disclose for each class of assets or liabilities where we use fair value, we need to disclose whether we have used level 1 inputs, level 2, or level 3. And there's a question how to calculate a monthly IRR. Sure, I'd be happy to do that, maybe just before the break, which is coming up. So let's look at one more change, and then I'll show you how to calculate the IRR, and then we'll take a short break. Change number 10 is giving us guidance on how to account for the sales return inventory assets. The new standard says that when you have goods you've sold to customers and you have a probability or expectation that some of them are going to be returned to you, that these are recorded as inventory. So they are part of your inventory. So even you've given it to the customer, but you still record as inventory because you know through your history, your practice, your familiarity with the asset, you know that some of them will be returned. And the amount of the returns will be recorded as inventory. And the standard now provides explicit guidance how to do this that did not exist before. We're going to record at cost less any expected cost of recovery and any allowance for possible decreases in the value of those products. So there might be damage, it might be out of date, the selling price might have changed. So there was some confusion and uncertainty before about how to account for this inventory, because inventory in IFRS for SMEs is accounted for at cost. So they provided this guidance to require us to create an allowance. So we create an allowance for the expected decline in the value. Okay, so that's the first 10 changes. So we have 20 changes we're looking at. We've looked at 10 of the major changes. We're going to take a break, but I'm going to take just 2 minutes to share with everybody how to do the IRR because it was asked. And we can go ahead and use this example of this motorcycle to calculate the IRR. I'm going to use Google Sheets. The only accurate way to calculate the IRR is to use a spreadsheet such as Google Sheets or Excel. And what we want to do is we want to set up the cash flows in the months. We have month 0, that is the very first day, today. Put here month. Month 1, month 2, month 3. And on the first day, we're going to put the cash price minus any deposit or down payment. And from the example here, the cash price $2,300, down payment is $500. So cash price $2,300, down payment was how much? $500. And for each month, we want to put the payment. And in our example, the balance the customer owes is $2,500. And the customer must pay over a period of 24 months. So it actually comes to this number. And the payment is the same every month. Okay. And we have 24 months. Now you asked me how to find the IRR. You can find the monthly IRR. And here is the big secret, how to find the IRR. You just type the formula IRR. Open parenthesis, and we select the cash flows. Oh, sorry, small adjustment. That first cash flow on time 0, we need to make negative. because it represents assets we've given out. And payment here, positive, means cash coming in. Okay, so let's do the IRR. IRR. And we select these. It says 3%. We'll bring the decimal out 2.8%. Okay, so you don't need to be a financial genius to calculate IRR. You just need to be able to type IRR. Now, there are other types of IRR, such as modified IRR, and we should not use those. We should use the simple IRR. Now, to compare with the market rate, you can take the monthly IRR times 12 to get an annual IRR. And you might check that just to make sure it's more than the market rate. If it's more than the market rate, then you're good to go. But if it's significantly under the market rate, then it is a sign that your cash price is too high, and you should revise that cash price. Okay, so as long as it's close to the market rate or higher than the market rate, then you are fine. Okay, so that's how you calculate the IRR. Now we're going to take a short break. We're going to take just a 10-minute break. And I'll see you back here at 3:38. Welcome back, everybody. I see that Satya asked, when will the book be out, the IFRS Resumes 2025? Do you need a new book because you studied 2015, the 2015 standard? Yes, you need a new book. We will share the PDF of the standard with everybody for free, so you can get a free copy. But for hard copy, I'm afraid you're going to have to pay for that on your own. And yes, the slides I'm presenting today, we will share with everybody. So we will share with you these slides. We will also share with you a copy of the standard. I see that our team in the chat, they've already shared a Google Drive with the slides and the standard. So you can already download now. If you go to the webinar chat, there's a link to the new standard and these slides. And after the webinar, we will share a copy of the video in that same folder. And there was a question about change number 10. What is the time period? Well, the time period for the return of inventory, it's there's no rule about it. It's only whatever you have agreed with your customers to allow them to return it. You may have a formal contract with them, or you might have a constructive liability. So it's there's no rule. It's whatever you have agreed with your customer. And there's a question about withholding tax. So in case there are costs where you have withheld withholding tax from another person, the gross amount will be recorded as your expense. And the withholding tax is not your expense. That gross amount is included in the cost of your cost of sales or the cost of your asset. Withholding tax is not our expense when we withhold, it's the expense of the other person. There's a question about consolidation. Although I have left out consolidation from today's presentation, the question is, what if our company meets the criteria to use IFRS resumes, but our parent company must use IFRS? No problem, we can still use IFRS resumes, but when the parent consolidates our company, when they consolidate our financial report, they will need to make some adjustments to comply with IFRS. So for your separate entity, if you meet the criteria to use IFRS resumes, you can use, even though your parent may be required to use IFRS. So no problem. Another question, do all enterprises that meet the criteria to use IFRS resumes must follow the new standard from January 2027? The answer is yes. The answer is yes, if you are following IFRS resumes or CIFRS resumes. And The question is, if you don't use it by that date, will you be fined by ACCAR? Yes, probably. You will be fined by ACCAR. And a question about retrospective application. That means you need to change the numbers in your statement of financial position and your statement of profit or loss, the numbers for last year, to be updated following the policies that you have applied this year. We will have another seminar, another CPD seminar on transition. And in the transition, we will review how to do the retrospective application. And there are a lot of exemptions from the retrospective application to make it easier for us. Okay, great. So let's continue. The next big change is relevant to agricultural companies, is trees that give produce are now accounted for as PPE, and we record at cost less accumulated depreciation. Now, this is for bearer plants. The standard doesn't say tree, the standard says bearer plants. What they mean is they mean any plant that gives you produce for more than 1 year. So a mango tree might give you produce for 10 years. A rubber tree might give you produce for 20 years. So any plant, it doesn't need to be a tree. It could be, could also for the sugar cane. The sugar cane root system that grows the sugar cane every year, that might be used for 5 to 10 years. In that case, the sugar cane root also would be a bearer plant because it is producing the sugar cane for more than 1 year. So a bearer plant is any tree or plant that gives you produce for more than 1 year. Now, I did say trees, but it doesn't need to be a tree. But it must be a plant. It cannot be an animal. So cows that give you milk, we cannot use cost less depreciation. So all livestock, cows, chickens, etc., pigs must be accounted for at following the old standard at fair value. Trees, the bearer plant is only a tree that gives you produce. So there are some cases where there are plantations, for example, of acacia or eucalyptus, where the trees are grown to cut the tree and get the wood. So that is only giving you the produce one time when you cut the tree to get the wood for timber or lumber. So that is not a bearer plant because it does not give you produce every year or for more than 1 year. So the bearer plants are plants that give you produce more than 1 year. So cashew trees, mango trees, rubber trees. And this change is great for us because previously they required us to account at fair value, although there was an exemption of undue cost and burden. But it's nice to have this automatic recording as PPE because it's really difficult or almost impossible to find the fair value of a tree. So now we can record at cost less accumulated depreciation. So cost less accumulated depreciation, paragraph 7.17.3. And now they are included and applied. We apply the rules of PPE in section 17. And the definition of bearer plant, I did describe a bit. A bearer plant gives you agricultural produce. So it would not include bearer plants, would not be including the trees in a golf course, landscaping, for example. It must give produce. It gives produce for more than one period. So that excludes the trees for timber. There's also the trees. There are a number of plantations in Cambodia that grow trees for incense. And in Arabic, they say ud. In Khmer, we say klemjan. And in English, we say agar wood. And those plantations do not provide the produce more than one period because you cut the tree, similar to timber. So that would not be a bearer plant. That would be a biological asset. And has a remote likelihood of being sold as agricultural produce, the tree itself. So for example, the rubber trees, we might, if we needed to, we might cut them and sell them. But as long as the likelihood of that is remote, then we will account for it as a bearer plant. Okay, so this is a great simplification of the standard. Bearer plants automatically recorded, accounted for as PPE. And this is aligning with IFRS as well. So IFRS already has this bearer plant accounting. So now we have it in IFRS SMEs. That's good for us. Another change, a small change, probably won't affect many businesses, but depreciation based on revenue is now prohibited. And it says in paragraph 17.22 that depreciation methods based on revenue are not appropriate. It says the same thing for intangible asset 2. It says we presume that amortization based on revenue generated is inappropriate. However, an entity can rebut this assumption for intangible assets. The standard does not allow the rebuttal for PPE. So for PPE, it's more strict. It's more of an absolute, cannot use this depreciation method. However, there's kind of an exception because they do allow depreciation based on units of production. And the units of production should be aligned with, it's going to be pretty close to revenue. And there is still this remaining contradiction between IFRS SMEs allowing the depreciation based on units of production, but IFRS SMEs also says you must depreciate when the asset is available for use, even when the asset is idle. So even you're not using the asset, you should begin depreciating, even when you're not using the asset. And there's a question about the mango farm and the tree, the residual value. Yes, there may be some residual value to the tree, the scrap value. So you may have some small residual value out of the timber, yes. And the other question is for the mango farm, do you harvest the mango? Yes, once you harvest the mango, it is your inventory. But the trees, the mango trees are your PPE. Now, something else that's staying the same is, thank God, Section 20 leases is unchanged and does not align with IFRS 16. So in IFRS 16, we recognize the right of use asset when we are the lessee under an operating lease. And it's a hassle. I think nobody likes that. So thankfully, they have not included the right of use asset for operating leases in IFRS SMEs. And really, the section 20 on leases, no changes, not even small changes. Just, I think maybe a few words here or there, but almost no changes at all. So no substantial changes. So lease accounting stays the same. The next change number 13, is interesting because it's normally a requirement for bigger companies. It's a new requirement on provisions for restructuring. Restructuring is when you close down a big part of your business, you fire lots of staff, you dismiss lots of managers. And we may record a provision, but IFRS and IFRS for SMEs, the ISB, the IFRS Foundation, they don't like this provision for restructuring. They don't like it because it has been abused a lot. It has been abused by many companies to reduce expenses in some years and increase expenses in other years. So companies might, when profits are good, they may make a restructuring provision to reduce expenses in years where profits are low or there's a loss. So it has been used by managers to manipulate earnings, to smooth earnings. And they don't like it. So in the new standard, they have introduced restrictions. They've introduced limitations on it. They said that you can only have this provision if you have a detailed formal plan for restructuring. And you have made those affected by your plan to expect that it will be carried out by, for example, starting to implement the plan or announcing it to the people affected. So this is a limitation now on recognizing a provision for restructuring. And this limitation is done to try to help avoid managers from using provisions for restructuring to smooth their profits. This requirement has been in IAS 37 for many years, maybe 20 years or more. And so it had been left out of IFRS resumes, and now it is included in IFRS resumes. Okay, now we're coming to the revenue section, and the revenue section is the biggest change. The biggest changes have been to revenue recognition. And before we continue, just quick to answer, Sionette asks about cows. Animals must be accounted for at fair value at the end of the year. So at the reporting date, you need to find the fair value of your animals, and you may value them up a little bit or down a little bit, and that gain or loss will be recorded as income or expense. Chun-Li is asking a very good question about mangoes. So when you pick a mango, now you have inventory. So we debit inventory. What do we credit? Well, following the standard strictly, you credit a fair value gain in the biological asset. However, what most companies do is they will normally simply wait until it's sold and recognize revenue. So credit revenue rather than the fair value gain. And recording to revenue when you sell it, there is a slight timing difference, but not very long, because when you pick the mango, you're not going to wait very long before you sell it, right? You're going to be selling it pretty quickly. So most companies don't record the fair value gain when you pick it. Most companies just wait until they actually sell the produce and they record the revenue from the sale of the produce. However, at the end of the year, if you have any mangoes in inventory on the reporting date, then you will debit inventory and credit fair value gain from biological asset. So during the year, you don't need to record the fair value gain. You can wait until you sell the produce. But at the end of the year, on December 31, in case you have any produce in inventory, you will need to record a gain or loss on the recognition of that inventory. Okay, so let's go to the revenue recognition. The revenue recognition in IFRS for SMEs is in section 23, and it has been totally changed. The old section 23 has been deleted, it's gone. It's been replaced by a new section 23 that follows IFRS 15. There are some differences with IFRS 15, mainly differences in simplification, less requirement for disclosure. Also, some of the language is more simple. Now, one of the changes to the revenue recognition I've already reviewed with you, which is that any financing where you will receive the payments in less than 12 months do not need to be discounted to the present value. So that's one big change. Another big change is here that the revenue recognition, we follow the 5-step model that we have in IFRS 15. And there, number one, identify the contract with the customer. Do you have an agreement with your customer to provide them goods or service? And revenue is defined as income from customers. Step 2, identify what did you promise to give the customer. In IFRS 15, they say identify the obligations. So it's interesting in IFRS for SMEs, they try to make it use a more simple language instead of obligations. They say the promises. So we use the word promise. I don't know if that's a better word. So what did you promise? So you list what you've promised. For example, maybe you promised to give the customer a phone and a phone service together. Step 3, determine the transaction price. The transaction price means the total amount of payment or consideration that you will receive from your customer. So continuing with the example of the phone and the phone service, let's say that the customer will pay us $1,000. Now in step 4, this $1,000, step 4 is to allocate the transaction price to each promise. Okay, so we promise to give a phone, we'll allocate to the phone, and we'll allocate to the phone service. And why did they put this 5-step model? They put this 5-step model because what was happening before is companies would allocate the $1,000, they would allocate all to the phone, or they would allocate all to the service. So companies may pick one or more of the promises and allocate the transaction price to one of the promises. Now the standard's clear. IFRS 15 is clear. IFRS for SMEs is now clear. We must allocate the transaction price to each of the promises in the contract. And we cannot be biased. We must be neutral. The allocation here, 700, 300, the allocation must be made on the standalone, based on the standalone price of the products. And in case you've given a discount for a package, we will reduce the standalone price for both products or each promise proportional to the overall discount. So this helps us to avoid companies manipulating revenue. It helps us give a more truthful recognition of the revenue we've earned by allocating revenue to each service or product we give the customer. The last step is to record the revenue when each promise is fulfilled. That means when you have given the phone, you will record the revenue for the phone. When you have given the service, you will recognize the revenue for the service. This is the 5-step model. Although conceptually it changes how we think about recording revenue, In practice, it shouldn't change much of what we did before, because even under the old standard, we should have been already allocating the revenue to each product or service. And in fact, the IFRS Foundation, they provided educational material that instructed us to allocate like this. So conceptually it changes, the standard has changed, but it shouldn't be actually changing. We should already be doing something like this. However, it makes it easier for users because now in the standard, it's very clear, it's very explicit how to record revenue. The next big change for revenue is revenue for houses that are under construction. And houses under construction, we can say, are off plan. And this is referring to a development project such as Borai in Cambodia, Phnom Penh, Borai Peng Huot, Borai Pipuk Tamai. I'm kind of old. I haven't learned all the names of the new Borai. Before, in the 2015 standard, there was this paragraph 23A.14. And that paragraph in the old standard said that if the customer does not have control of the design features, the main design features of the house, the sale of a house is sale of inventory at a point in time. So, oh, by the way, that's a typo. It shouldn't say 2015 standard. It should say 2015 standard, sorry. So that old standard, 2015, 23A14, what that meant is for when you sold a house in a barai or a condo, then following that paragraph, you would not have any revenue until you have handed over the house to the customer. And the standard, the old standard, 2015, did not have the no alternative use language that is in IFRS 15. In IFRS 15, if you create an asset for a customer and there's no alternative use for that asset, it means that it must be given to that customer. You recognize the revenue over time. So you recognize the revenue as you do the construction. And that was in contrast to IFRS for SMEs, which was saying in 23A.14 is saying that you have to wait until you finish. But now the new standard aligns with IFRS. So now in the new standard, when you sell houses, apartments, condos off plan, you're going to recognize the revenue as you do the construction over time. Why is that? It's because we will recognize the revenue for a good or service over time if any of these criteria are met. Number one, a customer receives and immediately uses the benefit. Now for houses, it's not the case because someone who buys a condo or a house cannot use the condo or house when it's not finished. So criteria A is not met for a partially constructed house. B, a customer controls the asset as the entity makes or improves the asset. And this in Cambodia is true for most off-plan sale of houses, for most developments, because most of the time in Cambodia, when the customer buys a house in a barai during the construction or an apartment, they normally have a right to sell the asset to another person. They can sell that house to another person during construction. They don't need to wait until the construction is finished. And because the customer has the right to sell the asset to someone else, that indicates that the customer has control of that asset. So we are meeting criteria B. And we are also meeting criteria C. Criteria C says the asset created by the entity's performance cannot be easily redirected to another customer. So if you buy a house in a Barai and the house is under construction and you've been making payments, can the Barai sell that house to another person? No. You have a contractual agreement. The customer has a contractual agreement with the developer for that particular apartment on that floor in that location. It cannot be easily redirected to another customer. So in the case of houses, off-plan apartments, we meet the criteria B and C, which means that we will recognize the seller, the developer, real estate developer, they will recognize the revenue for the house over the time. Over time means that over the time of the construction. And the standard says if any of these three criteria, so any one, and we actually meet two, so it's clear. And there's guidance, an asset cannot be easily redirected to another customer if the entity would sell at a significantly lower price, or there are contractual restrictions, and that is the restriction that we have in Cambodia. Most of the time you will have a contract to purchase or own or control a particular house, particular apartment. However, there is no standard for the contracts among developers. So you will need, as an accountant or auditor, you'll need to read the substance of the contract to ensure that the customer does or does not have control. I have not included the journal entries for an off-plan sale of house because the accounting is quite detailed. However, I've included some simple amounts where we can get an idea, an understanding of how the sale of the house would be accounted for. So in this example, the customer has a down payment in the beginning of $30,000. The handover is going to be after 24 months. So that means the customer is going to pay for 24 months. After 24 months, they get to move in the house. Handover means they'll do an inspection, they get the keys, they can begin to use the house. And 24 payments times the monthly payment of $1,600. And then after the handover, there's another 96 months. So this is typical of developments that the customer is going to pay some of the payments before the completion of the house, and they will continue to make some payments after the completion of the house. Now, if we add all these together, 30 plus 38,400 plus 153,600, it comes to 222,000. Those are the total payments. However, those total payments, 222,000, it is not all revenue for the house. Remember the example from earlier today, the example of the motorcycle. Some of the revenue of the motorcycle is financing income. The same with the house. So the cash price of the house is 180,000. The total payments 222,000, 222,000 less 180,000, that gives us 42,000. The 42,000 is financing income. So the income from the house is only 180, and the difference between the two is going to be financing income. And that financing income will not be recognized for the first 2 years. The financing income is only recognized once the customer receives the house. So the financing income would be recorded in month 25 and then onwards to month 96. So before handover, no financing income, but after the handover, we're going to have financing income using the IRR, the same as with the motorcycle. Now, the total cost of construction, including land, we say is $100,000. The costs incurred in year one, $50,000. So how much have we delivered to the customer? $50,000 divided by $100,000, we say that we have finished 50%. So this is the stage of completion. Now in the standard, stage of completion is kind of the old-fashioned word. Now they say percent satisfaction. Okay, so anyway, we say we have finished 50% of the work. We've given 50% of the asset to the customer. So we'll recognize revenue based on the cash price 180 times 50%. So we've given half of the asset to the customer. We also recognize half of the revenue. But notice we don't use the revenue of the total payments. We use the revenue of the cash price, because the total payments is including financing, and the financing income must be recognized separately as financing income, or we can call it interest income. The interest income will be accounted for using a monthly IRR. In this example, I haven't included the calculation, but the monthly IRR in this example is 0.7%. So we've recognized 50% in the first year, and we assume in the next year we finished another 50%. The main lesson here is now we recognize the income from the sale of off-plan houses. We recognize month by month, year by year, as we do the work. We do not wait until the handover date. Right. So when you finish 50%, you have not handed over to the customer, right? But you still have revenue. So you have revenue even though you have not handed over to the customer. Cash price means what price would the developer accept to sell the house if the customer paid cash in advance. So the 222,000, that is going to be a bigger number because the customer is paying over a period of many years. Excuse me. And of course, the seller, the developer must charge a higher price because they have the risk of default. So the payments here, 222,000, is including the value of the house, the sales value of the house, plus the sales value or the service value of the financing. And so Kantiri, yes, you're correct. The next big change to revenue is not something that we see in Cambodia that much. I wish we could see more of it because it's an opportunity to make money, which is a sale of warranties. So do we need to recognize revenue for warranties? And now this change in IFRS for SMEs aligns with IFRS. And to summarize the standard here, the new paragraph, to summarize it, we record revenue for warranty if the customer has paid extra for a warranty. If the customer has not paid extra for the warranty, if the warranty is just included as with the product as it's given, it's automatically included with the product to the customer, there's no revenue for the warranty. So how about you, your laptop, your computer? Did you pay for the warranty, or was it just included in the price? Probably for most of you, your warranty is included in the price. So the seller doesn't need to recognize any separate revenue. But this is a lost opportunity for sellers in Cambodia because the sellers can sell additional warranties, can sell extended warranties for 2 more years, 3 more years, and could make a lot of money. Anyway, to make a long story short about the warranties, we record revenue for warranties only when the customer has paid separately for it. They've paid an additional amount for that warranty. The next big change is guidance on principal versus agent. The old standard, the 2015 standard, included a number of references to agents and accounting for agents and principal. They included references, but they did not include a definition. So that made it challenging for preparers to clearly identify, are we an agent, are we not an agent? So now the new standard includes specific guidance to help you understand whether you're an agent or not. Also specific guidance on the accounting for agent income. Now, even though the 2015 standard wasn't quite clear on the topic, there was educational material that showed that the intention of IFRS Foundation was that we follow the same accounting as IFRS. So the agent accounting in IFRS for SMEs, it should have been, and it is still aligned with IFRS. And the idea of a principal is the person who controls the good. So if the principal can take back the product from the agent, then that's an indication that the company is a principal. If they can tell the agent to forward those goods to another seller, additional indicators are the principal is the company that is responsible for fulfilling the promise to transfer the good or give the service. For example, airlines, even though the travel agent sells the ticket, the travel agent is not responsible for providing the service. The principal, the airline, will be responsible for providing the service. The entity has inventory risk. Now, the biggest risk of inventory is that you cannot sell the inventory. But it's interesting that the new standard does not identify that risk. The new standard identifies, it says only inventory risk, and it gives as an example the risk that the inventory is damaged. And you are a principal if you have the power to set prices. So these are some indicators of a principal. These are new to the standard. And the accounting also now is explicit. So even though before the IFRS Foundation, they expected us to follow the practice in IFRS, now they have made it clear. The principal records revenue as the gross amount of the consideration received, and the agent records revenue only the amount of the fee or the commission. So that means even though the travel agent might have received $1,000 for the plane ticket, the $1,000 is not the revenue of the agent. The revenue of the agent is only the commission that they get to keep. So in terms of debits and credits, when the travel agent receives cash $1,000, they'll debit cash $1,000. They'll credit maybe $50 as the commission revenue, and the $950 remaining would be credited to a payable that they owe to the principal. So the principal records the gross amount as revenue, and the agent records the fee or the commission. So only the fee or the commission. So even though you're receiving millions and millions of dollars as an agent, but your revenue is only that net commission you get to keep. That is your revenue. Another specific guidance on revenue is for the license revenue. This also brings us into alignment with IFRS 15. So we can consider a license to use a brand or license to use software. And one question that there was some variety in practice where some companies were recording revenue at the point of time that they gave the license, whereas other companies was recording revenue over the period of the license period. So normally we would record the revenue over the license period, as long as we are including upgrades, adding functions to the product or to the software, or we're doing marketing value added, we're promoting the brand. And we will record revenue over time, over the period of the license. So how about recognizing revenue at a point in time? Can we recognize all the revenue right away? Only if there are no changes to that asset. Only if the asset that is being licensed doesn't change as it exists at the point in time. That means it doesn't change. So if there was software that was sold and there were no further functions or updates provided to that software, then you could record the revenue at a point in time. It's worth noting something that stays the same is the impairment of assets. Section 27 remains mostly the same. And just to remind everybody, it continues to allow us to avoid value in use, okay? Because we hate to use value in use because that requires so many unreliable estimates. So although the recoverable amount concept in impairment of assets requires us to use the higher fair value, less cost of disposal, and value in use, we actually can avoid using value in use most of the time. Because the standard says in paragraph 27.12, it says you don't need to find the value in use if the fair value is more than the carrying amount, because it means you don't have impairment. Okay, so that's the first way to get out of looking at value in use. The second way is more powerful, actually. The second way is if there's no reason to believe that the asset's value in use is more than the fair value less cost to sell, the fair value less cost to sell may be used. So that means you don't need to use the value in use if you don't have any reason to believe the value in use is more than the fair value. Now, when would you be able to use value in use? Value in use would be more useful or relevant for valuing a business. So if you're looking at impairment of a business or a branch or a subsidiary, then in that case, you need to find the value in use. Or you're impairing the factory, the total factory as a business unit, as a cash generating unit. But otherwise, we can mostly, using these two paragraphs, we can mostly avoid wasting time to find the value in use. Last change is disclosure of management personnel services from another company. So the 2015 standard required us to disclose the total compensation for management. But what if the manager is a company? So there's a lot of times where the parent company is providing management services. So maybe the airport company in Cambodia, perhaps the parent company in France, they're providing management services. If you receive management services from another company, do we need to disclose as part of our disclosure of management compensation? The answer is yes. We do need to include, here the last sentence, we do need to disclose the cost incurred for the management services. But you do not need to disclose any amounts related to the individual people that provided those services. So if that company that gave you the management services has certain employees or directors that were providing the service, you don't need to disclose anything about the compensation to the individual. You only need to disclose the compensation that you pay to the company. And so this is a new disclosure that was not required, and it helps to clear up some uncertainty. So some companies weren't disclosing this at all. Some companies were not sure if they needed to disclose the compensation to the individual people. Okay, so now this is a clarification that makes it clear to everybody. We disclose the amount that's received from the management company, but we don't need to disclose the compensation of the individuals from that company. And ladies and gentlemen, this is the end of our presentation. We will have another CPD workshop in a few months' time, and that workshop is going to be conducted by a member of the IFRS for SMEs working group, who is with the IFRS Foundation working group. And his presentation is going to cover the transition to the new standard, and what needs to be restated, what doesn't need to be restated. And so that'll be a very practical process of following the new standard. Remember, this is not required until 2027, but you might want to follow it now because there might be a lot of things that are helpful for you. For example, maybe you don't want to record the financing for assets with financing less than 12 months. So this new standard can make your life a lot easier. And especially those of you who have plantation with trees, the bare plant accounting might make your life a lot easier as well. So ladies and gentlemen, we're going to share the documents with you. We already shared in the Google folder. We are gonna, I can stop sharing. And we're going to be sharing the recording of the video as well, and asking everybody to give some evaluation, some feedback about today's session. And I really hope that you can share more questions. If you have more questions over the next few weeks, you can share them with me, share them with our team, and we'll make sure to include those in our next session together. So friends, you must really love accounting because you're here with me on a Sunday afternoon. So thank you very much for being here with me. I really appreciate your valuable time, participation, and late happy Easter. Susadai Cham Tamai, late happy New Year. Song Chun Patipo Ten Boom Baka Ayuk Vanat Sokat Palek Kumbai Klinkle Lai. Hope to see everybody soon. Have a great week and can't wait to catch up with you in person. And for my Chinese friends, 再见. While we're here, I can ask, I see there's a couple questions. Chen Pat, if you're still here. If somebody doesn't say they're using the new standard, then it's automatically assumed that they're using the 2015 standard. So if we early adopt, we must disclose that we have early adopted the new standard. If we don't disclose that we have early adopted the new standard, then we assume that we're following the old standard. And Chitra asks, is security deposit, prepayment, staff advance, what is a financial instrument? Well, remember, financial instrument is any agreement about money. A right to receive money, a right to pay money, obligation to pay money. So in the case of a prepayment, when you've prepaid for rent, for example, you have a right to receive rent. You don't have a right to receive money. So prepayment is not a financial instrument. A staff advance, if you have a right to receive money back from the staff, then yes, that is a financial instrument because it's a right to receive cash. So financial instrument is anything that's, remember, instrument means agreement, finance means money, so financial instrument means any agreement about money. So is there a right to receive money or right to receive a payment? Is there an obligation to make a payment? That's a financial instrument. And yes, we have the new course in July. We're going to study the new standard. We will stop studying the old standard. Even in class now, I'm already teaching the new standard compared to the old standard. So we have a new IFRS resumes class starting in July, and we will study in detail the new standard. And Erit said the link's not working. You mean the link to the documents, I guess. We'll check that. Maybe there's many people clicking. So yes, Rexmy, we will all study the new standard. And Lead is asking, what is a reasonable benchmark of cost of inventory comparing to revenue? I'm not really sure what you mean because there's no reason to benchmark your cost because your cost is whatever you really have as a cost. So whatever you truly spent, that is your cost. So if you spend $10, your cost is $10. So you don't need to benchmark. But there's some cases for a cost you might need to make some estimates, such as in production. But those estimates still based on your normal cost. Oh, I see. Dara, you're saying the link to the survey is not valid. Okay. Okay, everybody, gonna say goodbye. I'm gonna go home, play with my 2-year-old daughter, Aliana. We'll keep that in mind, Lee Song. You may. Thank you. You too. Bye, everybody. You're welcome.